Welcome to this explainer on the Investor's Guide to DSCR. We are jumping right in today because we're breaking down one of the absolutely foundational concepts in real estate syndication. We're going to strip away all the heavy jargon and look exactly at how these deals are evaluated behind closed doors. Now, before a lender even glances at those beautifully renovated interiors, or the fancy new community amenities, or that glossy 100-page marketing package for a multifamily property, they're looking for something else. There is an ultimate mystery number that essentially dictates loan approvals. Before any commercial lender signs off on a multifamily loan, they are running the math on this one specific metric above almost everything else. Section 1, the most important number. It's called DSCR, or the Debt Service Coverage Ratio. Now, the formula is actually beautifully simple. DSCR equals NOI divided by annual debt service. Let's unpack that really quickly. NOI, or net operating income, is what the property actually earns from its day-to-day operations. So that's all the rent and income minus the operational expenses, but crucially, this is the amount calculated before you pay the mortgage. The annual debt service, on the flip side, is just the total principal and interest payments required by the lender for that entire year. So ultimately, this ratio tells you exactly how much of an income cushion exists above that hard debt obligation. Section 2, the math behind DSCR. Okay, let's dive into this. Let's look at how this actually plays out in the real world, using a pretty realistic 50-unit apartment example. Imagine our property is generating a healthy net operating income of $360,000. Now, let's say the annual debt service, those principal and interest payments we just talked about, totals $270,000. If we take that $360,000 NOI and simply divide it by the $270,000 debt service, we get a DSCR of 1.33. But what does that actually mean for you as an investor? It means that for every single dollar of debt this property carries, it's generating $1.33 in income. That extra 33 cents, that is your breathing room. That's your cushion. So you might be wondering, is a 1.33 actually good? Well, to put that into perspective, the magic number for most lenders usually sits right around 1.20. Most lenders want to see at least a 1.20 to 1.25 minimum DSCR before they'll even consider approving the loan. They basically want to know for sure that if things get a little bumpy out there, there's at least a 20 to 25 cent cushion on every dollar owed to keep those loan payments flowing smoothly.
Section 3, a moving target.
Now, there is a massive myth in real estate investing that DSCR is just a little checkbox you clear at the closing table. Honestly, it's time to shatter that misconception. Listen to this. It is not just a number you clear at closing and forget about. The reality of multifamily operations is that your debt service coverage ratio is a living, breathing metric. It is constantly moving throughout the entire hold period simply because your net operating income is constantly changing. If your income goes up or down, or your expenses suddenly shift, your DSCR is going to shift right along with it. So the absolutely crucial point here is understanding what exactly causes that safety cushion to shrink, or as we say in the industry, to compress. Let's look at the operational realities. If your occupancy drops because tenants start moving out, well, your income falls and your DSCR compresses. If your expenses suddenly spike, say property taxes shoot way up or surprise maintenance costs surge, your NOI drops and again, your DSCR compresses. Or think about this one. If those beautiful property renovations you planned take way longer than expected, delaying those higher rents you modeled for, yep, your DSCR compresses. These are very real everyday factors that actively erode your safety cushion. Section 4, questions for your operator. And this brilliantly illustrates the vital difference between a highly risky deal and a safe one. Look at a deal underwritten right at that 1.20 lender minimum. It has almost zero buffer. Sure, it might barely get the loan approved, but if occupancy drops even a tiny bit, you are suddenly underwater and facing a massive lender problem. By contrast, look at a deal underwritten at a DSCR of 1.40 or higher. This deal has plenty of room to absorb real-world variance. Things can go wrong, and let's be real, in real estate they often do, but you still have more than enough income flowing in to cover the debt comfortably without breaking a sweat. Therefore, your primary rule of thumb moving forward is this. As a passive investor, always ask your operator what the going-in DSCR is. This single metric will tell you instantly how conservatively the deal was structured from day one. It shows you whether the operator is actually building a healthy safety net for your capital or if they're just walking a tightrope right above the lender's bare minimum requirements. But hey, don't just stop at that going-in number. I want to leave you with this final incredibly powerful question to ask before you invest a single dime. What does your stress scenario look like? Literally ask them. If occupancy drops by 10% or if expenses suddenly jump, where exactly does the DSCR fall? Because knowing the answer to that question is exactly what separates hopeful participants from truly savvy, focused investors. Thanks for joining me in this explainer. Now go out there and ask the tough questions.